recording. Great.
Perfect.
Okay.
Thank you.
Yeah. Hi, everyone. Today we have Tristan here as our guest speaker for the case study. I'm going to hand it off to Tristan to kind of take the lead with this, but he's a staff data scientist at Munich Re, and I think we're in for a treat with this presentation. Yeah.
Thank you. Just I guess a point to note, I'm in my son's room today. I'm presenting from home, so just in case you see anything funny in the background, like the balloons and everything up there. So I'll get into it. I just want to have like one quick little point of order. So content shown and opinions expressed are solely mine, so not those of my employer. So I'm going to cover some background on my industry and everything, but any opinions will be mine alone, just sort of as a disclaimer. So here's really going to be the agenda that we're going to go through. So I'm going to start off with who I am. So a little bit about my background, educational background to work experience and how I kind of ended up in the role I'm in now. And then I'm going to talk through what insurance and reinsurance are. And so this is the industry that I work in. And so I'm going to give a bit of a background about really what the industry is all about, what kind of problems we face, and on the reinsurance side, which is the, I guess, subfield I work in, why reinsurance exists as well. And then I'm going to talk about my team in particular. So the structure of our data science and analytics teams, the various positions and sort of the roles and responsibilities there. I'm going to talk through the problems that we solve. So kind of building off of that intro to insurance and reinsurance, I'm going to talk about really some of the problems the industry is facing, where it's going, and how data science fits into those problems and how it attempts to solve them. Some of the challenges we face there as well. And then I'm going to talk a little bit about the technology that we use in the day-to-day. And then I think we'll probably stop there, pause for questions, I think take a short break, and then we'll go into a case study. And so I should forget to update this agenda slide, but previously the case study I had was talking about the value of a new data source. In this case, we'll be talking about a model to really gauge the risk of a particular type of insurance, which is a group insurance policy. And I'll get into that later, but that's really what the case study will be talking through is. So a little bit about who I am. So I started my educational background in physics at McGill. So while I was there, I had some internship experience within reinsurance, which is the field I now work in. And that was really with an actuarial focus. And also while I was there, I had some research experience focusing on experimental, astrophysics. Really a lot of that centered around the data analysis part. And so for me, I kind of took some of that experience and some of my interest there. And as I was graduating, data science was a growing emerging field. And so for me, it seemed like really a promising way to leverage some of my technical skills and experience. And so I went into data science post-grad, and I actually started my career at Bell, so doing data science there. And really at Bell, my focus was on operational improvement, analytics there. And so I did a lot of projects related to operational improvement, cost savings, automation, things like that. And I actually did a fair bit of work as well in NLP. And this was sort of early stage natural language processing. So pre-LLMs, using LSTMs and other, I guess, more rudimentary type of NLP approaches. But a few years working there within the sort of telecom space, I thought back to my experiences in reinsurance, and I really liked that industry, the way things were structured there, and the types of problems they solved. And so I actually, from there, moved into my current company and current role, which is Munich Re, and there I'm a staff data scientist, and we're working on a lot of problems related to, broadly speaking, risk assessment. So I work in a team that is North American wide, so Canada and the US based. And I deal with a lot of problems both internally and client facing related to risk assessment. So building models to assess risk, analyzing the value of new data sources. And I'll get into more what that means later, but really tying in some of the actuarial background that I had before with some of the data science in the current role I'm in. Other fun facts about me. So I am a father to a 6-year-old. I do a lot of running. I read a fair bit. I try to read. I used to be a competitive Taekwondo athlete when I was a teenager. Now I do things like pickleball, play squash. yeah, it's a little about me, I guess on the personal side. So I'll just start off here with really a background on what insurance is. And I think, most people here will, have an idea of what insurance is. I think it's by virtue of, um, being an adult, you probably have one, if not multiple insurance coverages. But here Webster's defines it as a coverage by contract whereby one party undertakes to indemnify or guarantee another against loss or specified contingency or peril. But really what that means is, insurance is a contract where some risk that an individual or business may think may occur, they want to sort of mitigate that risk. So they enter into a contract with an insurance company where in the event of that, adverse event or that risk actually happening, there is a coverage there, right? And so you can broadly think about insurance as falling into one of two categories. And so the first of those is, life, disability, health, annuity insurance, right? So here I have that called L&H or life and health, and the other being property and casualty insurance. And so that's more of your home, your auto coverages like that. And so these are, I guess, intuitively defined in some respects. So, one is really related to life and health, the other related to more objects. But really the biggest difference between the two, you can think about in terms of how it actually impacts, the work you do and the way the industry is structured is that the former, the life, health, disability side, those are longer term risks. And those are risks that are really only priced, you can think of one time, whereas the property and casualty side, so the home and auto, those are priced frequently and they're shorter term risks, right? So if you think about, car insurance as an example, when you get car insurance, you'll be offered a rate. You'll drive around for a year. Maybe you have an accident, maybe you don't. And then the next year you get, a mail that says, hey, your rates have gone up or they stay the same, or maybe they've decreased. But the insurance company is really covering you for a specified period of time, seeing what your risk level is. And then based on the experience they have with you, how many accidents you get into, things like that, they can reassess your risk and modify the price later on. On the life side, it's a little different because there wouldn't really be a purpose to getting life insurance if the premium depended on your health status in the future. It's really only assessed once. So if you have a life insurance product, you'll get what's called underwritten, and I'll talk a bit more about what underwriting is in a few slides. But you'll get underwritten. They'll give you a product at a specified price, and really that's your price forever. They're not going to go back and reassess you for the time period that insurance product covers. And so really the big implication of this is that for property and casualty insurance, because the time scales of the coverages are shorter, you can typically gauge the impact of changes or new technologies in a shorter period of time. And if there is any adverse movement, you could say, you can quickly act to correct that. So if you were to use a new model or technique to set the price of car insurance, and then you noticed in 1 year that the prices were a bit misaligned, maybe they're a little bit lower than you would have expected, it's easy to sort of make that correction and recover losses in the future. On the life side, because it's a longer term coverage, if you are to make a mistake in the pricing early on, you kind of have to live with that decision forever because you can't go back and readjust the price. And because in the life insurance side in particular, deaths are a very rare occurrence. It actually takes a very long amount of time to get a sense of how well things were done. And so we call that concept credibility. But really what that means is it can take sometimes 5, 10, or 15 years for enough deaths to accumulate on a block of insurance policies for a company to really gauge to a degree of statistical significance whether or not the prices were set correctly. And the implication of that on the life side, which is the side that I work on, is that there is this inbuilt conservatism around developing new technologies or taking new approaches. And so it really sets a high bar for implementing innovative or really novel techniques into some of these existing processes. So really at the core of insurance, both life, health, as well as property and casualty insurance is risk assessment or underwriting as it's called. And so this is the process when you apply for an insurance coverage, where the company would look at various attributes about the individual or the business, and they would determine the risk level. And from that assessment of the risk level related to that insurance product, they would set a price. And so on the life side, traditionally, this life underwriting process has been a very, you say, time consuming and invasive process. And so if you think back to 30 or 40 years ago, if you wanted to buy life insurance, you would go to somebody selling life insurance. You can think of a life insurance agent or broker, financial broker. You would fill out this lengthy application. And then the second step of the process would be that application would be submitted. And then sometime later, maybe 1 week, 2 weeks, 3 weeks, a nurse or a medical professional would, knock on your door and come to collect what we call fluids, which are, blood, urine, saliva panels, and those would be used to gain more information about the health status of an individual. So collecting things like what your blood sugar is to determine if you're diabetic or not, liver values, different metrics about your heart, things like that. Um, and in addition to that, they would sometimes order the entire medical history of the applicant through their doctor, and this would be actually delivered not in a structured digitized form, but in a free form, sometimes picture-based or faxed set of text. And so the result of this was that the life insurance underwriting process has historically been, quite invasive and quite lengthy. Typically taking in the order of months to actually be completed. And then in addition to that, all that information was reviewed manually. So, in opposition to, what you think of nowadays as an easy customer experience, this was a very difficult customer experience that was almost entirely manual and very, very time consuming. And so, really, there's been a push in recent years to get rid of this process or make it more customer friendly. And in doing so, minimize the time and the cost associated with doing the. So here I'm going to talk about what underwriting really is. And so back in the early days of underwriting, where fluids would be collected, everything was done by hand. The actual process of taking all of this information, whether it be these fluid panels or the information that was actually submitted on the application about an individual's medical history, or the medical history from the forms from a doctor, all that information would be analyzed by individuals called underwriters. And those underwriters would use what are called underwriting manuals or guides, in addition to expert judgment that they had built and sometimes some discretion to come to a decision on whether or not somebody could be offered life insurance, as well as what the risk class, really what the assessed risk of this individual would be, and as a result, what the price that would be charged would be. And I have a picture on the right of what one of those books looks like. I actually have a physical copy here of one of these books. So it's actually a very detailed and long manual that covers almost every health condition under the sun and has a resultant, you could say rating or pricing recommendation based on that. And so, as you can imagine, very tedious process, involves a lot of expert judgment, a lot of training to actually go through and do that. And so, really, there's been this push to also automate some of that decision making, and especially in the simpler cases, make this an automated process. And so I'll talk here really about what that's looked like in terms of the movement from the older paradigm to the newer paradigm. So underwriting started with these rule books or underwriting manuals. And as a next step, they didn't immediately move to models. Really what the next step was taking these rule books, and instead of having an individual go and look up a piece of information and see what it says in the guide, look at another piece of information, see what it says in the guide. The first step of that process to move this set of risk assessment into a more, modern paradigm or more customer-friendly view was to take that manual decisioning and move it into what we call a rule engine or an automated decisioning engine. And this first step was actually not ML-based, so there wasn't any really sophisticated algorithms happening. It was really just taking what was a book and codifying that into a, essentially a decision tree, and that enabled at least some automation to start occurring. And so that was really the first step within this process that really opened up the door for an increase in technological input into this underwriting process. And then from there, with a rules engine and with a digitized application, the next step is incorporating some intelligence into that. So as you build out a rules engine, the implication of that is that what used to be a set of data that existed in a variety of unstructured forms. So if you think about a paper application in years past, or like I was saying, sometimes those PDFs or those fax documents or lab tests that were faxed over again, you now have that information consolidated in a digital format. And when you have this information now consolidated, you can begin to understand what's happening there and start building off of that. And so one of the implications of then digitizing data and creating these rules engines was that you could start building machine learning models and sort of a twofold approach, improving that process with machine learning models. And so that rules engine implementation resulted in more data, and the increase of data really opened the door for machine learning. And I'll say, really as a first step in the process, it wasn't to go in and really replace the traditional way of doing underwriting. So, the traditional way of doing underwriting, you can think of as a decision tree, like I said. So, oftentimes it is, you can think of like a human built model where each of these pieces of medical information leads to an outcome. And instead of building off of a training data set like with the model, oftentimes there wasn't enough data available a long time ago. And so a lot of these outcomes were populated by expert opinion or medical studies. And so because of the conservatism of the industry, this has really stayed the baseline of what risk assessment underwriting is in the industry, and everything's been sort of built around that and gradually chipped away at it. So as a first step, the models weren't directly assessing risk. They weren't really replacing that rules engine or decision tree based approach that historically was the core of risk assessment, but they were really supplementing in different ways. And so one of the big and early use cases for machine learning models within this process of underwriting was what we would call misrepresentation models. And those misrepresentation models are models that are built to identify misrepresentation, which is another word for essentially lying or non-disclosure, right? So when you apply for insurance, you're given an application, and in the application, people are asked, have you had this condition? Have you engaged in this behavior in the past? And there's an assumption there that people will tell the truth. And typically the way to, validate that people are telling the truth in the past was through the use of those lab panels. So if somebody said, no, I do not have diabetes, and a lab panel was ordered, and the lab panel said that, their glucose was at a certain level that was indicative of diabetes, you could identify where somebody was either not being truthful or maybe was unaware of a certain condition. As you move towards a better customer experience where you attempt to minimize the use of those and sort of get rid of that requirement, you open up the door for increasing misrepresentation or increasing omission of information on these applications, and you don't have a way to understand or parse that out on individuals. And so one of the first tools implemented machine learning wise was these misrepresentation models, where essentially you would look at a set of data in the past where you had information, identify characteristics of individuals that were likely to misrepresent or not disclose conditions or behaviors, and use that to identify people who should be what is called kicked out for additional evidence. So within these processes, even though there's an aim that nobody should have to have fluids collected, there's oftentimes what you would call kick-out groups where individuals are picked up either through rules or through models as having increased risk and then sent off or referred out for additional evidence requirements. And what that means is, although they might go through the path of no fluids or no labs, they would ultimately have something ordered, and just to ensure that there isn't misrepresentation slipping into the pool of risks. And as it's gotten more sophisticated, we've seen the nature of models changing. So we're kind of moving now into an era where models are used to set prices more directly, I should say, or assess risk more directly. So, initially they were really used to guardrail this process of underwriting where it was being simplified and there was, fears of an increased amount of risk slipping in. Now it's actually moving to the core. And I think a lot of this is driven as well by an increased amount of data that we're seeing on applicants, particularly in the US. Now, switching gears for just a second. So, I mentioned in one of the first slides that I don't work at a direct insurance company. I work at what's called a reinsurance company. And so, just speaking very high level, what is a reinsurance company? A reinsurance company is a company that insures insurance companies. And so you can think of that as another layer of risk management. So insurance companies insure consumers because there's a risk and they want that risk covered. They want that security. Insurance companies seek out reinsurance for oftentimes the same reasons, although there are a variety of reasons for reinsurance. One of the, I'd say, basic examples of this is for diversification reasons. And so I'll give the example here of a insurer that issues home insurance, and then home insurance is mostly centered around a certain geography. We'll say it's, in the southeastern US, so Florida, Georgia. Now, obviously, this area is going to be very prone to hurricanes, and so they might want to offload some of the risk because, one bad hurricane year means, a really bad year for the insurance. They want to kind of smooth out some of the volatility that the weather could bring, right? So that's one reason. Another is, coverage of tail events or black swan events. And so I list here, a pandemic, for example. A lot of businesses had, or large events had coverages like that. I think the Olympics had coverages for a pandemic, for example, where although it's a very small risk, you still want to have insurance for that. And then on the life and health side, which is the side I work on, there's also a lot of financial motivation for this as well. So here, I say freeing capital to be invested in more productive assets, providing increased cash flow, smoothing liabilities. Without getting into too much financial detail here, you can think of these reinsurance products as sometimes being custom solution that are sort of designed to deal with some financial goal that a company has. And so, an example of that could be a company is writing a lot of new business, and because of that, there's a lot of upfront expenses. So that can kind of choke their balance sheet a little bit, and so they can engage in reinsurance to kind of adjust the way cash flows move in and sort of free up some capital for other uses. That's just one example. These structures are sometimes very cut and dry. There's very common types of reinsurance that is almost commoditized in the market, and then there's also very customized financial structures for reinsurance as well. But one of the things there for reinsurance is that it is a market that serves insurance companies, and so as a individual that works at a reinsurance company, our clients would be these insurers. And I think what's interesting about that as well is we compete in a market with other reinsurance companies for these reinsurance contracts. And obviously price is a factor there, but in addition to that, while we compete on price, we also compete in terms of service. And so we oftentimes, as a reinsurance company, act as consultants to these insurance companies. So we'll oftentimes offer different services, advice, things like that to the companies. And actually working in the reinsurance space gives you a unique perspective because you get to work with all the various insurance companies. You get sort of a bird's eye view of the market to see what company X is doing, what company Y is doing, and really be able to gauge industry trends, industry movements, things like that. And I think one of the things that separates reinsurers from just pure consultants when dealing with that aspect of it is that with consulting, it's fee-based. Someone comes in, consults on engagement, makes a recommendation, they're sort of done. With reinsurance, oftentimes these are tied to a reinsurance contract. And what a reinsurance contract is in simple terms, oftentimes them giving a part of their business to us, right? So if an insurance company is underwriting a bunch of individuals, assessing the risk, issuing them policies, one very common type of reinsurance is that they would, cede or send over a portion of those policies to us. And so, because of that, we also now have sort of skin in the game. So if we make a recommendation or we provide a service related to underwriting, the impact of that recommendation or the impact of that service, if it does impact the underwriting process or any process really within um, their whole value chain, we're actually going to feel the impact on our balance sheet as well because we're what we say on the risk for that business as well. So it's a very interesting sort of industry and the way that it operates and interacts with insurance companies. And here it's on the right, I have a chart that kind of outlines some of the types of reinsurance you can have. Um, we have treaty and facultative. Treaty is, you can think of as large contracts. Facultative is one-off contracts. And so most reinsurance is you call treaty reinsurance or contract reinsurance. But every once in a while, you have sort of special cases that are dealt with on a one-off basis. And that's what you call facultative. And so shifting gears a little bit again. So I work on, as I mentioned at the beginning, a North American team. So we're called the North American Integrated Analytics Team, and we are a North American-wide analytics team that operates in both the Canadian and U.S. markets, and I guess very minutely in Caribbean markets as well. But really, our goals are to use technology to improve the way that risk is assessed in the industry, right? So we want to enable both ourselves and insurance companies to um, improve their risk assessment and make it a simpler, more customer focused process. And also, in doing so, leverage new data sources to replace older, outdated data sources, essentially. We also have a big focus on expanding the pool of individuals we insure. So, one of the drawbacks of the traditional way of underwriting is that it is very cut and dry, and a lot of it is not purely data driven, as I said. A lot of it is really constructed based on hodgepodge of studies sometimes, or judgment based. And it's oftentimes constructed using the best data we have, which is not necessarily all the data, right? And if you think about, pre-big data eras, this was oftentimes very, very thin data. And so as a result, there's sort of this conservatism built into the process. And there's a lot of people who are really just not eligible for insurance, right? So because they are seen as a higher risk, if the company cannot accurately gauge how high of a risk they are past that threshold, they're typically decline insurance coverage. And so one of our team's goals is really to, amongst those individuals who might currently be declined for insurance, find ways to more accurately assess the risk and as a result be able to actually offer them insurance coverages and really increase the amount of people that we can insure. And I mean, that's, I think, a good business goal, increasing the number of customers we can serve. But I think it's also, there's a humanitarian aspect to that in, serving groups of people that might have, in the past been unable to be insured and unable to benefit from the service that is life insurance. Another, focus of our team is, using data and technology to create products and solutions that help improve and extend the lives of policyholders. And so, if you think about the way life insurance works, the underwriting happens, somebody is issued a policy, and that might be a lifelong policy, and then they have that until death, more or less, right? Or until the term of the policy say expires. But from the perspective of an insurance company, we underwrite the risk and that's locked in. But we have an incentive for policyholders to enable them to have the longest, healthiest lives possible. So life insurance companies would be over the moon if they could underwrite individuals and then have them live forever, right? Because you don't want people to die, right? You have an incentive to have people not die and to live long lives. And so one of the things we focus on is how can we identify ways to improve the lives of existing policyholders, using various pieces of data, whether it be wearable data, other pieces of data, and then how do we identify which individuals are likely to benefit from these different wellness solutions? And then, it's really doing all of that while iterating rapidly and leading the industry in our security and ethical practices. So I think as a team, we've always focused on being at the forefront in terms of both our data security, application security, as well as some of the bias and fairness considerations as well in the industry. So as a team, particularly in the US, we've really actually led some of the conversations with regulators around things like bias and fairness in machine learning models and setting up frameworks to both analyze that and monitor that over time. And within our team, we have really a set of positions there. So first would be data scientists, and those would be people like myself who are primarily concerned with, I'd say, building these different solutions. So, building models, carrying out analytics solutions. Some of it's more, I'd say, product focused data science. So some of what we do is around larger, more scalable products that we offer broadly to various insurance companies in the market. And so a lot of it is really working on features for those. Others, it's more consulting, like data science engagements that target specific needs of insurance companies. And then we have data engineering, and those individuals will typically handle a lot of, I'd say, the back end processes and infrastructure within our team. So some of them will deal with things like our storage accounts, our databases, and the virtual machines that we do a lot of our work on, things of that nature, as well as some of the security policies and practices within the team. And then we have software engineers that work on, again, some of those more scalable products that the team builds. And they work on a lot of the software components of those. So not necessarily the model related, but really the overarching applications themselves. And then we have the machine learning engineers. And on our team, machine learning engineers really sit as intermediaries almost between, data and software engineers and data scientists. And I'd say primarily what they focus on is building the frameworks to, build and deploy models. So they'll deal with, model deployment, model monitoring, and things of that nature. And then we have a DevOps and security team that also deals with some of the application deployment, some of the security. And then finally, I think one of the things that our team's always focused on is doing things that are impactful to the business and are building off of the existing frameworks in the industry and doing so in a way that allows them to be effective. And so within the team, we've always had embedded specialists within the industry. So on our team, we have underwriters who are those individuals that historically have been responsible for doing the risk assessment. So we, typically when building out some of these solutions, work hand in hand with the underwriters to understand, how can we make sure any model we build or any tool we build is going to be, palatable to underwriters that are going to ultimately use it, and how is it taking into account, some of the business aspects that are on the ground that we might not be aware of. Sorry. So here I'm just going to talk a little bit about our tech stack. So really, I'd say we're primarily a Python shop. So Python development is I'd say core to a lot of what we do, both in terms of building and deploying machine learning models, performing analytics tools, and then also just building our applications. And then we're also a company that works off of cloud platforms. So in our case, it's Azure, but I think we're also contemplating movement to AWS potentially, but very similar cloud-based computing. So we have our databases, storage accounts for data, virtual machines, things of that nature. A lot of our applications are deployed with Kubernetes, and I don't have a full exhaustive list of engineering tools we have here, but our engineering team does also make use of particular sets of tools. And then another one that we do leverage for some of the pipelines that we'll build is Databricks. So that's another primarily web-based solution that allows you to either write Python code or Spark code, and allows you to leverage some distributed computing to deal with you say larger data sets. And so we'll use it for some of the more computationally intensive projects or exercises we have where the data is very, very large. And then also it has some inbuilt pipelining that we will also make use of. In the past, we did use Airflow for our pipelines, but we, I guess, migrated more recently to Databricks for that use. So here is really our problem space. So I've touched on it already in a few places, but life insurance for many of the reasons I've mentioned has always been very risk averse and slow, to adopt new technologies, right? And a lot of that is due to the fact that if you make a bad decision, essentially you misprice something, you assess risk incorrectly, you have to live with that decision for a long period of time. And because of how rare an event death is, it takes a long time for what we call credibility to build, or for enough deaths to accumulate where you have some statistical confidence in, where that average mortality rate is going to sit. So because of that long time scale of understanding if a mistake has been made, and the longer time scale that you have to live with the results of that mistake, there's been this risk aversion to actually changing things, right? The idea is sort of, if it isn't broken, we don't want to toy around with it. And so as a result, there's been a very high bar to actually implement changes and do new things. But also, there's been simultaneously this really big push to move away from the traditional way of doing things, particularly in the realm of risk assessment. So um, that underwriting process involves the collection of lab tests and really invasive unstructured data sources. It's really time consuming. It's not optimal for the customer. It takes a lot of resources on the insurance side to actually go through and manually do all that risk assessment. And it actually costs a lot of money as well. So those lab tests, they require somebody to go draw the fluids, a lab to process them. So there's a cost there as well. And so there's been this push to move away from that and do underwriting in a more automated way. And there's been a few things that have really driven that, I would say. So one of those is really the cost element. Another has been this proliferation of new data sources. So particularly in the United States, structured medical data has become more widely available. So things like prescription history, medical claim history, and as a result, those can be incorporated into the underwriting process, and they can actually take the place of some of the more invasive data sources, potentially, and they can do so in a way that is less invasive to a customer. And so the availability of those data sources has, allowed a bit more movement into what you call an automated decisioning space. And then another one more recently that I think pushed a lot of companies in both the US and Canada to really accelerate the way that they're doing their accelerated underwriting, or their fluidless, you can call underwriting, was COVID. So when COVID hit, a lot of lab testing centers actually got shut down. And so companies had to very quickly adapt or die, more or less, right? So I wouldn't say die, but because there was this inability to actually do the lab tests, and there were people still applying for life insurance, a lot of companies had to very quickly allow consumers to apply and get issued insurance without the use of labs. They had to make a decision whether or not to decline all these individuals, or issue the policies potentially with some increase in price. And so they chose the former, or the latter, sorry, where they were going to relax the requirement to get these lab tests and issue these policies to more individuals. And so that's sort of what happened. And post COVID, this is still sort of remained. So a lot of companies increased the limits to which they would do this, and they didn't really bring them back in. So that was really another driver of that. And then, with everything, although there is this inbuilt conservatism, once I think one company makes a move, everybody wants to move so they're not missing out. If your competitor is doing something in a more customer-friendly way, it's less invasive, it's quicker, it's going to drive you to do the same thing. And so I think as companies have started moving this direction, it's really propelled the industry to follow suit. And so that's really the space that we work in. And one of the largest focus areas for us is accelerated underwriting, as it's called. And we really want to, further enable this and further, drive this. And in doing so, really push the industry in that direction, and enable them to do so in a way that gives them confidence in this less invasive process. And so really to do that, it means identifying, assessing new data sources, and then taking those data sources and leveraging them to the best of our abilities. And so that can mean a few different things. That can mean building a model using a new data source or an existing data source and implementing that within an accelerated underwriting process. but it can also mean sometimes simpler approaches where you implement rules or you use analyses of various data sources to just guide modifications to the underwriting process itself. But really, that would be one of the big overarching goals of our team and one of the big problem areas that we seek to tackle. Some of the challenges we face. So I'd say the challenges we face are numerous. So the first one, which is becoming um, less pronounced, but still exists, especially in the United States and the market of smaller companies, is lack of digitized data. So I'd say, in Canada, most companies are, most insurance companies are allowing individuals to submit digital applications. In the US, this is mostly the case, although there still is a segment of the market in both countries where data is not digitized, where people are still filling out, you think it was a paper application where you put your name on a piece of paper, you fill in the information there, and that's how the information is stored. And oftentimes this information is not digitized. And so that presents an issue when trying to understand the actual data that went into the underwriting process in the past and kind of limits your ability to do things there. And also, if applications are happening on paper, you cannot create a paper machine learning model, right? So you can't really enable the process in that respect as well. So that's a diminishing issue, but that is an issue that we faced in the past and still face to a smaller degree. The other is lack of data standardization. And so I would say, this hits us in many different ways. This is across life insurance applications. Different companies have different ways of asking questions. One company might ask, have you smoked in the last 5 years? Another company might ask, give me the date of your last tobacco use. Another company might ask, how many tobacco products you use in a week, right? And so this is all different ways of asking more or less the same thing, and standardizing them can be a challenge. They also come in a variety of formats as well. And then even amongst some of the newer data sources within the industry, there's oftentimes a lack of standardizations. And so in the United States, for example, one of the newest data sources of interest is something called electronic health record. And that is, people might have heard of it in Canada, but it's really a record of your health, right? So it's a collection of various medical records related to an individual. And those are collected from a variety of different sources, so different hospital systems through these third-party aggregators. And while there is a lot more structure to these than typical medical documents that were faxed in the past, there still is a lot of free-form text, and different aggregators of information also have different standards. So that's also another issue as well, is how do you, take this information, standardize it, make it useful for building rules, building models, etc. Another one is a lack of existing consents to use third-party data. So I haven't touched on the legal bias piece, but I'll touch on that a little bit in the case study. But consents are very important, particularly in Canada. In Canada, we have a federal data privacy law called PIPEDA, and I think C24's table to replace that, or has been passed. I don't know exactly the current state, but more or less we have law that limits the ability of companies to use consumer data for different uses without their explicit consent, right? So if you think about a typical underwriting process, before you actually fill out the application, you'll be prompted with, do we have your consent to do this? And that will allow, a company to actually retrieve certain pieces of data because you got the explicit consent of the consumer. And typically when data is collected, there is a consent there as well to use it for specific uses, right? So this could be, a use for a specific platform, or in the healthcare context, this could be used for actually, medical related use cases, but not necessarily applying to other use cases. But oftentimes, we are in a position where a new data source becomes, available, where, it could be leveraged within an underwriting process. But in order to leverage it within an underwriting process, you need to understand the value that data source has. So you might have to build a model using that data source, or understand how to build a simple rule off of that data source. But in order to do that, you need to then find an existing group of people and append that data source to them. And if you don't have the consent of those individuals to append that data source, then you can't make use of it immediately. So that can present a challenge. It can actually extend the time scale to which you carry out these initiatives. So you might have consent now, and then you might start collecting data, but then it could take 1, 2, 3, 4, 5 years to actually build up an adequate pool to do the work to understand the value. So that's one other issue there. And like I said, there's a higher bar compared to other industries for adoption of new tools and techniques. So the industry is very risk averse in general, and there's a lot of due diligence that's done when making modifications to these core processes, and so that can present challenges, but slow down the rate at which you can implement things and actually make it more laborious to do things that in other industries might be much easier to do. And then another one that's Canada specific. So I've talked about these these data sources in passing. Most of these are U.S. based. So in the U.S., you have things like prescription drug data, you have medical claims data, you have now these electronic health records, credit data. You have a variety of data sources in the US. And part of the reason why they're available is there's just a larger market. But another one is they also have less stringent data privacy laws. And so there's just more data available on individuals. Um, in Canada, we have a much lower amount of this new data available. And so there's much less that can be used to replace these existing data sources, although there's still a wish to do what companies in the US are doing as well. So, Canadian companies still want to have an accelerated underwriting program where they can relax these fluid testing requirements, but they don't have additional data sources to put in place of those fluids to identify things like misrepresentation and limit the amount of error. So it's a tougher proposition in Canada to sometimes do the same things, and you're reliant on less data to try to achieve the same goals. Another one is higher regulatory involvement. So this is kind of part and parcel to being in insurance, is that there's oftentimes high regulatory involvement in particular areas. I'd say underwriting is actually maybe less so than some of the other areas, pricing being an example. When you're setting rates directly, for example, I know on the P&C side, you have to actually file those. On the life side, there's still a lot of regulation involved in those processes. And so when there's more regulation and more scrutiny there, again, creates a higher bar to actually execute on these types of uses. But as well, it also changes the dynamic of actually carrying out these projects. And so, one example of that is interpretability. So for certain use cases, raw prediction might be sufficient, right? Where the model cross-validated is performing well, people might be happy. I'd say within insurance, that's definitely not the case. Like black box solutions are not something that people really want to engage with. And so building a solution, a model that is interpretable is oftentimes a requirement, and that's particularly true in the more regulated areas of the business. And so that's something that we have to take into consideration when doing any of the work that we do. And then another one that is a challenge, but also I would say a strength we can play into as well is the regulatory landscape related to machine learning, new data sources, AI. There's actually a law in Colorado passed, I believe, last year, a year and a half ago, that was the first of its kind that put explicit guidelines around what they call ECDIS, or it was really like non-traditional data sources within underwriting and some of the potential bias implications there. And so we're seeing a lot more laws pop up related to the use of new data sources, and in particular, with a focus on the potential bias they introduce into the risk assessment process. And so that regulatory landscape is something we have to really deal with and understand, although it is an area that we have always sort of pushed to do in a certain way. So we sorry. So this is an area that we have really pushed to also, have implemented. And so on one hand, it's sort of a strength. On the other hand, it is something that we have to try to preempt when building out our solutions. Actually, I don't have a question slide here, but I'm going to pause for now and open the floor for questions. Oh, I see a hand up, sorry. Kaylee, if you can read out the names because I'm on a single monitor.
Yeah. We have Katju.
Hi, are you able to hear me?
Yep, I can hear you.
Okay. I have a few questions, and
Yep.
you can take in whichever ones that you wish to. In the non-traditional um, sources of data, would you include something like whole genome sequencing, like the genomes of individuals? Is that something that you have thought about? I know that I don't think it's being implemented now, but is that like the future?
Yeah,
Like,
yeah. So, oh, sorry. Yeah, so I guess yeah, I can tackle that one first. So, um, this is a potential data source that has come up. I think right now, for a few reasons, insurance companies are kind of staying away from it. So a bit of background, what's kind of interesting if you go and apply for life insurance right now is almost every life insurance application will have a question on it or multiple questions that ask you about family history. So it will ask things like, is there anybody in your family, parents, grandparents, aunts, uncles that have had heart attack or stroke before the age of 50, or have a diagnosis of cancer before the age of 60, or any family history of any disease, things like that. Even sometimes genetic diseases as well. And so there's a lot of these questions that are currently asked in life insurance that are almost proxies for genetic markers for certain disease. And those are widely used within the underwriting process as is. And so the incorporation of like genomic sequencing or any sort of genetic DNA type of variables would be really a more direct way of doing that. That being said, there are a lot of concerns about sort of the bias implications of that, as well as just the ethical realm of using that type of data. And so I think right now people are treading very cautiously around that. I can't speak directly on this. I'm a lawyer, but I think there might be maybe in certain jurisdictions some current legal issues with potentially doing that. But it is something that has popped up and has been thought about, just because of the, I guess, ethical conundrums that could occur. People are hesitant to actually start actioning. A really good question.
We have a question in the chat that
Yep.
says, should someone derive underwriting rules from data available in the US and then apply it to a country like Canada where data is less available?
Great question. So yeah, underwriting rules, I would say like the crux of the risk assessment. A lot of that exists sort of as is, and I would say sometimes they do pull data sources, or like they do pull rules between one jurisdiction or another if there isn't Canadian specific information. The one thing about Canada in particular is that versus the US is that we have a very different healthcare system, and there's, I would say, um, I guess speaking broadly, you think of the Canadian healthcare system as being more equitable, maybe. So there isn't as much socioeconomic effects that we see in mortality, so that can change the dynamics. Um, so I guess yeah, that's sort of one thing that can affect it. And I'd say in terms of the traditional rules, um, you can apply them with some caution. On the model side, that also can be true, but I would say if you can't get the data source on a go forward basis either, then it also limits the effectiveness. So if you're, for example, building a model that only used information on an underwriting application, you didn't have any Canadian data, you could potentially build something on US data and apply it in the Canadian market with some adjustments. But if you're building something on, say, medical claims data in the US, you wouldn't have access to that in Canada, and so it wouldn't make sense to implement that. So that's sort of one constraint as well. If there were constraints around not having any data in the past, but you had it on a look forward basis, such as in a theoretical context, that would be a potential thing you could do is build something on historical US data and then use it in Canada. But then again, you just have to take into consideration some of the socioeconomic impacts of mortality that vary between the countries, and some of those Canadian specific, nuances to using it. Yeah, good question.
We have a hand up from Richard.
Yeah.
Hi, Tristan.
Hey.
I have a two-part question. Since we're
Okay.
starting off on our journey here, learning Python, and next will be SQL,
Yep.
what kind of position would you say would be available to someone at our level in the insurance reinsurance industry? What would that position be called, and what other types of supplemental things would benefit our candidacy to take on that role? You had mentioned at the beginning Databricks and
Yeah.
Kubernetes, and those look like a little bit too advanced kind of packaging container stuff. I don't even think I got to learn Python first. So
Yeah.
how would, if I wanted to get into the insurance reinsurance business, what type of position would I be looking at?
Yeah, so I'll handle that in two parts. So I'd say within insurance reinsurance, I'd say they're still very data driven in multiple aspects. So our team in particular is focused on purely, I'd say, ML, improving processes, new data sources. There's also just a ton of data driven roles that are more internally focused, not necessarily in incorporating new data sources, but analytics based reporting as well. So I'd say like across the whole data realm, like we have the set of positions in our team, but then like our company has an operations team where we have data analysts that are automating like file intake processes, that are reporting on claims processes, things like that. So there's data analysts there, data specialists there as well. And so there's I'd say a whole variety of positions within insurance reinsurance that are data driven, data related as well, that span ML, dashboarding, more engineering ETL type stuff as well. And those range from data analysts, data scientists, things like that. In terms of I'd say tools and technology. So I listed sort of those few, and I would say like Kubernetes is something that I wouldn't even really touch on. Like that's more, I'd say, on the engineering side. A lot of what we use is tools within Azure, and Azure is just one example there. There's AWS, there's Google Cloud. I'd say like a lot of companies have a lot of solutions sort of embedded within those. But that's not something that I'd say you can build skills. It's more just a platform you can kind of use. Like there are specific aspects that to learn, but it's not something that I guess you could sort of learn the engineering side and everything externally, but I'd say that's one of those things that you typically kind of just get accustomed to on the job, like how to connect to a particular virtual machine, or understanding the nuance of the database structures in one versus another. I think Python, SQL. I think a lot of it comes down to the different packages and use cases. And then another one I would say that's not necessarily tool related, but just I always recommend experience wise is insurance is like this. I know other industries are like this. It was like this in telecom. The data is a lot messier than I think people are used to in more academic context sometimes. It comes in a variety of formats. The errors can be very strange sometimes. Like you sometimes have a lot of systematic issues with data, and there's a lot of judgment that goes into how to deal with those. And a lot of the job, I'd say, is not just building a model or building a tool, but it's getting to the position where you can actually start doing that, right? So I think it's important to work with different types of data and get comfortable with different formats, different structures, and then also just getting comfortable with different situations and making decisions with imperfect data, if that makes sense.
So do they hire people that are at the entry level, or is it really more of an intermediate type environment?
Yeah, so I would say our team, it's varied over time. So when I first joined the team, it was more intermediate. So that was more experience hiring. I think in more recent years, we've moved to hiring people more that are fresh grads and then training up. But it does vary a little bit, I would say. It depends on the team as well. It's on the data science side. we're definitely more open to hiring people who are less experienced. And then I think on like the machine learning engineering side, for example, they typically still hire more experienced hires. Does that sort of answer your question? Oh,
Yeah,
you're on.
I think as we go through this class, there may be some people here who
Yeah.
are aware of where they want to position themselves when they get out, and then others are just like, well, I don't know, you know, what's the government like? What's this industry like? What's that industry like? But I realize that some industries are not as friendly to people at the entry level.
Yeah. No, I think it definitely varies. Like when I worked in telecom, I found that was like at Bell, for example, they were um very open to hiring like fresh grads and everything. But it does vary by industry, right? And I think it also depends on the nature of the role. If it's more operational analysis, sort of like focused in that respect, I'd say more open to entry level usually, and then more research focused can be a bit trickier, if that makes sense.
Okay, great. Thank you very much.
Perfect. We have a hand up from Ken.
Hi, Tristan.
Hey,
Hi, thanks for the session so far. Very insightful.
thank you.
I just have two parts to my question as well. The first one is, do you have any advice for someone coming from an unrelated industry trying to break into data? For example, do hiring managers look at projects or portfolio, those kind of things? And my second question, I'm just curious,
Mhm.
what's the background of your team? Are they all from similar backgrounds, or is your team made up of people from different backgrounds?
Good question. Yeah, so I guess breaking in, like I would say, yeah, projects are definitely something that are looked at. And I think in particular, like something that highlights almost a particular like passion or interest, and that's a little like unique, can also be standoutish, right? So that's like one way to kind of stand out there. Um, or doing like volunteer type experience as well, or like little side projects can be useful. I would say like on our team, it's definitely quite mixed. So like when I guess broke into data science, I didn't think there were really any data science programs, and so like my background's in physics, and then I know some people I work with have like backgrounds in physics, econ, math. We have somebody in our team who has a background in like psychology. There's people with backgrounds in like a variety of different fields and different paths to kind of get to where we are. Also within insurance, I'd say, and especially reinsurance, actuaries are there's tons of actuaries in reinsurance, right? It's like half our company is actuaries. I'm also like a partially qualified actuary. So that's we have people who come from that background as well on our team that were more subject matter within insurance, and then kind of we're dealing with more traditional processes and roles, and then kind of moved into our team there. But I'd say like it varies a lot within our team, and then now we have people as well that come from I guess more data science programs and stuff as well, but very mixed. And I would say yeah, like my advice on like projects would be um, something that like sort of stands out as a unique kind of project or like showcases your interest in a particular thing can be more impactful there.
Thank you.
Perfect. We have a question in the chat and then one more hand up. So the question in the chat was from Katju again, and it was, do you also use R in your work?
Yeah, so good question. So once in a while. So I think when our team first started, probably 8 years ago, everybody used R. All the stuff we did back then was entirely R based. I think we gradually moved towards Python over that period of time, and now it's almost entirely Python based. Although I do use R on occasion. The one thing I find about R is it's a very like academic language, so it's still used, I think, more widely in academia. And so as a result, sometimes more like novel things that come out will come out to R first before they're brought over into Python. So one example of that where I had to use R was I've given like talks and stuff on data anonymization. And so this is like ways to go beyond just dropping like name, for example, in a data set to further enhance the security of it. And there's a package in R that's like very very detailed, very robust for carrying out a variety of anonymization techniques and then actually gauging the anonymity level of a data set. And there really isn't an analog in Python. Like there's some packages that capture some small parts of it, but nothing that is nearly as comprehensive. And so that's one case where I actually used R. And the way I use R, though, funny enough, in that context, is I use R within Python. So there's like a Python package called like rpy2, and I do like a pass through into R. So I almost embed the R code in a Python script and just use it that way. But I would say yes, like it's still used for certain uses, but less common than Python where we are. But although I do know that there are some places that still more heavily rely on R.
We have one last hand up from Farshid.
Yep. Okay, hi Tristan. So my first question is again about the tools that you're using. So you mentioned Databricks. I wonder if all the teams in your organization have already switched to Databricks or they're using different tools.
Yeah, so I'd say it's a mix, right? So and even us, like we still use local Python or virtual machines for a lot of what we do. And we started moving away from Airflow in the last few years towards Databricks. But there are other teams that make use of different tech stacks as well. So like I can't speak with the entirety of Munich Re because it's like a multinational, but I know like our team, we have a central team in Germany that is kind of moving there, but aren't quite there yet. And then other teams do make use of different toolkits as well. Our team is kind of unique in that, like on my company's global scale, in that I think we kind of are off on our own in terms of what we do. Like we're not as intertwined with the global IT structure, I would say, as other analytics and data-oriented teams are globally. So I'd say like we tend to be first to move in different directions. So I think Databricks is becoming more popular for sure.
Yeah.
But I don't know if everybody's moved over yet to Databricks for all their uses. They might be using alternatives as well.
Okay, so my other question is like, how big is the customer base of your organization? And I'm asking this since I want to know like the size of the data that you're working with. Have you guys ever tried any Spark API or Scala in Databricks or anything
Yeah.
similar?
Yeah. So like I would say, so my company generally is like we're a global organization. I'd say we're not I'd say, but I guess we are the largest reinsurance company in the world. So across most markets, we're going to work with almost all the insurance companies. If you look at like our set of reinsured business, like it's tens of millions of people, I would say. I don't want to put an exact number on it, but it's a large proportion of the insurance markets in both Canada and the US, right? We are like the largest reinsurer in the market. So we do work with most companies and reinsure a large chunk of the market. And so given that we don't have things in the billions, right? But when you're working with a pool of individuals appended to a data source, it's in the tens of millions, and we do make use of like Spark, then Databricks, and like some of the big data aspects. So that was one of the reasons we use Spark, is like we can make use of the clusters, kind of do some distributed stuff there. But then a lot of our data sets are smaller, especially if it's like one client specific project where they want us to do something for them. That's going to be a smaller set of data potentially, and then you don't need to really make use of that. It's going to be overpowered for what you're looking to do.
Yep, thanks.
Thank you.
Sorry, Tristan, I accidentally skipped a couple questions in the chat.
Oh, yeah. No worries.
So we'll take Jason's question in the chat, and then Carlos, you had a question in the chat as well as your hand up. So to start with, Jason's, have you considered or faced any challenges or have thoughts around working with healthcare organizations to obtain synthetic data which are de-identified but have the same statistical significance for analysis and curb regulatory challenges in terms of PII, etc.?
Yeah. So I guess on the synthetic data front, So I talked about the data anonymization talk I did. So I did one version of that talk 2 years ago with somebody who runs a startup in Austria that does the synthetic data generation with a sort of focus on insurance companies in that respect. So like generating these synthetic data sets with health properties and everything as well. There are different ways sort of around the consent issue sometimes as well. So you can use synthetic data as one example, right, where you take the identified or de-identified data that isn't necessarily cleared for use case, and you extract the statistical properties of that data to create fake records and use those. There's also ways to tokenize or encrypt data as well, and you can make use of data in that respect. In terms of working with like healthcare organizations there, I think one of the issues in Canada as well is that not only do we not have like the consent necessarily, but there also aren't the technical structures in place to make use of the data. So like in the US, for example, like the electronic health records are one example where you have these health information exchanges and the data is already kind of flowing through them. And so you can think of like the pipes are already in place, and it's just about, redirecting them to different places, right? The water is going to flow through, and you just kind of reposition the pipes to where they're going to go. In Canada, we don't actually have those pipes built, so we couldn't even get that data to build synthetic data on it yet. But it is a good thought there, right? Because that is one way to kind of work around some of those challenges is with synthetic data.
Yeah, and I think I can add to that for Canada.
Yeah.
As well. I think there's challenges within the provinces, managing healthcare data as well, right? Like, for example, Alberta has a centralized system, but Ontario is kind of like in silos. So yeah, I totally get the challenges. But I always thought it was interesting to kind of use something like that, in a way to, curb the challenges around, these regulations and, privacy concerns as well. Yeah, but yeah, great, interesting thought.
Definitely, yeah.
And then Carlos, you have your hand up.
I think you're on mute.
Thank you. So thank you, Tristan. Thank you, Kaylee. So I have a question. It's a two-part question. So what is a day like in the life of a data scientist in your industry? So what do you do in a normal or average day? Is it more data cleaning or building models or going to meetings? And which are those tasks that you like the most? And which are the ones that you don't like the most? That was one part of the question. And the other one is for libraries and packages. So which are the one in Python, right? So which are the ones that you use the most?
Yeah.
Thank you.
Yeah, I like how you added meetings to the first set of things. It's like building models, cleaning data, meetings. Yeah, there's definitely a lot of meetings. And I think too, I've been at my company now for 4 years and change, I think, maybe. But I've sort of moved up a little bit now to where I also have some managerial responsibilities. And so I'd say that occupies some of my day now as well. So there's a fair bit that's like more, either project management or people management, organizational type stuff. That's probably like a quarter of my day on average. Otherwise, it's a mix of different things. So sometimes it is cleaning data. Sometimes it is building models or like brainstorming like approaches we're going to take. And then I'd say a lot of it too is, well, I guess in the past, and it varies the amount, is taking the results and like framing them and kind of either pitching a solution or delivering the results. So oftentimes, like if we build something for a client, it's taking that model and then summarizing the results, summarizing why it makes sense, why it kind of handled the problem they're looking to solve. Doing that. Sometimes it's like selling certain ideas to our management, right? So if we have an idea for a specific problem or a business area we want to kind of focus on, or a use case for a new data source, sometimes we want to sell our management on it. And so oftentimes that could mean prepping some like preliminary work on that, right? So an example of that could be like a project I did was taking a data source and using it to benchmark different parts of the industry. And so to do that, I didn't start by actually doing the exercise or building models to do that. It was more, proof of concept. This is what we have in the data set. These are the shortfalls. This is how we would kind of get there. And then we actually started building that out. So I'd say like my day-to-day is quite mixed depending on where I am in different projects. But some days it's like purely like parsing out data, building things. And then other days it's sometimes PowerPoints, other days it's meetings. But it varies a lot. But I'd say it's probably like 35% technical, 25% organizational, the other 40% like a blend of the two, like the code review or like putting decks together. Yeah. I don't know if that answers your question. That was maybe a bit vague. And then your second part was different packages. So, I mean, pandas, sklearn are like, very common ones. I use, recently I use like James Path a lot. I'm working with XMLs a lot. Trying to think of what else, like common packages. It depends a lot on the use case, right? So I used, funny enough, a package the other day. I played around with, this is a random aside, but I was working on a project recently internally where we wanted to use a model to create like an internal tool. And there were some thoughts that the team internally wouldn't have the technical acumen to be able to use a model to do what they want to do. And so I used a package that takes sklearn models and exports them into Excel, which actually exists, funny enough. It's not great. It's very hard to use, but I use that. But I'd say like packages, it's getting comfortable manipulating data. It's a big one. So like getting familiar to pandas, NumPy, SciPy. And then sklearn is going to, honestly, in the insurance context, going to handle a lot of the models that we're going to use. There's also, I was going to say we use a lot of GLMs as well, but then you can also build like XGBoost mortality models now. So we use XGBoost a lot. You can use a Poisson function there. So I say, yeah, that's sort of like the main ones, and then it depends on the specific project. But a lot of it's just like what data you're working with. Do you have some like particular use?
Amazing. Thank you.
Thank you.
Tristan, do we have time for one more question?
Yeah, I think we do one more and then maybe have like a short break and then come back.
Sounds great. Okay.
Yeah.
Igor, your hand is up, and that will be the last question for before the break.
Yeah, okay. Thank you, Tristan, for your presentation. It was very useful and very interesting. I have a short question just about the positions, because everybody aware about how powerful AI is getting. And what do you think? I just want to ask about your vision. Which position, in your opinion, is going to be combined in near future? Because we know that we have a different position, but sometimes just one person can cover different tasks with some new tools.
Yeah, that's a good question. So
which maybe will arise. Yeah, maybe you can see some new opportunities. Yeah, thank you.
Yeah, so I mean, LLMs have blown up over the last year or so. When I did that, I've gone back to this talk twice now, but I did a talk on synthetic data. We talked about using, neural networks to generate synthetic data. Nobody in the audience knew what that was. I presented to actuaries. Nobody had any sense of what that meant. And then we did the same talk a year later, after ChatGPT came out, and everybody immediately knew what neural networks were and had much more intuitive sense of that. So they've really blown up. I think there's been a lot of hype within all industries to implement LLMs in a variety of use cases. I'd say in life insurance, in line with the approaches before, it's been very cautious. So within my particular industry, I would say they're not using it to replace anything, but more speed up certain things. And there's a lot of guardrails around its use. So it's never going to make a direct decision, but might be used to summarize information, for example. And then that information would be fed to somebody. So it kind of save their time on actually going through and doing the summarization themselves. But I know other industries, they're thinking a more direct approach to making decisions and carrying out processes. If I had to say what's going to get consolidated? It's tough to say. Like, I mean, the immediate thought would be, you know, something like a process that is like processes that are sort of low risk organizational, but it's hard to say. Like, I think we're still early stages, and there's, you know, obviously concerns with things like hallucination, so we're still a few years away from seeing like fully agentic uses of these things. But yeah, in terms of opportunities, I mean, I think, you know, if the hype about LLMs, you know, proves to be right, and we can, you know, build off of that, I mean, I think there's going to be opportunity there to, I mean, do some building, sure, but really like the deployment around those different use cases will be a big area, I think, where you know, even if people are using, you know, wrappers of some common LLMs, right, for different use cases, or just slightly modifying them, you know, the engineering work and some of the analysis around those use cases, I think, will be a big area. So sort of building off of that, and that's something we've seen internally as well, as, you know, even taking an existing LLM and figuring out if you can use it for a certain use case. There's a lot of work around that analysis that requires like a fair bit of technical skills. Yeah, difficult question.
Thank you, Tristan. That was great.
Thank you.
So I think we'll take a 10-minute break now, and
Yeah.
then we'll hop back on the call at 7:33 if that works for everyone.
Yep.
Great. See you all then. Oh, I think you are on mute.
Sorry, yeah, I was just gonna say, you might have seen my son's head just poking through in the last little bit. He wanted a snack, so I just had to give him a snack. But yeah, just wanted to address that. If you saw like a little head going back and forth. Yeah. So yeah, I'm gonna go over the case study portion now. So it's my first time doing this one. And this one's actually looking at a use case within group insurance. And this is based off of a white paper that we published on our website. So this is a particular use case that would involve, you know, partnering with one of our clients, and it's dealing with use case in the US. And so I'm going to start off just by kind of talking through a little bit of background information. And I have here, I'll send you the slides after, but I have here, you know, linked the full paper just for anyone who's interested in reading through the whole thing. But really, I'll start talking about group life insurance to start off, because it is different than what we've talked about so far, which is what you call individual life. So when most people think of life insurance, they're going to think of individual life coverage. So that's a policy that you own. You go to somebody, you buy it, it covers your life. You have underwriting that's done on an individual level. And so that's all that I've really talked about so far. That's the accelerated underwriting, the fluids, all of that really applies to the individual life side. There's also a type of insurance called group life insurance, and many people will be familiar with that as well. That is priced and sold at a group level, right? And by group, you can think of an employer, a union, etc. So many times if you work for, in particular, large companies, you'll have a benefits enrollment. If you go to the benefits enrollment, sometimes they'll have included life insurance. So it'll say, you know, something that's 1 time or 2 times your salary. And then sometimes you'll have, you know, similar things for disability insurance, whatever, but that's what you call group coverage. And in contrast to individual coverage, group insurance is not underwritten individually, right? So you'll notice when you go through that process, if you are enrolling for your benefits, when you start a job, they're not going to ask you to submit a fluids panel or ask you really any questions, usually, about your health, right? And so those types of policies are not actually priced for the individual, they're priced for the whole group that it's offered to. So in that case, everybody in the company goes through that enrollment. Everybody in the company might have salary or insurance worth twice their salary. And so the company that's providing that service, that insurance service to the company, is going to price that insurance coverage over the entire group of people, over the entire pool. And that's really what the price is going to be. They're not going to price each individual coverage. They're going to set sort of an average price based on the characteristics of the entire group of people that are going to have this insurance coverage. And, you know, typically when this is done in a very, say rudimentary, but simplistic way. So they look at more or less the demographics of the pool and some other things, right? So, for example, a company that employs people who are older is going to have a higher mortality rate because, mortality is commensurate with age. The older you get, the higher the mortality rate. So a company that employs more older people should be charged more. Similarly, men have a higher mortality rate than women typically do. So a company that is more predominantly male might have a higher rate. And then there are additional adjustments that are oftentimes applied to this as well to give more precision. But those are typically not overly complex. They might be related to the nature of the industry or the size of the company, right? So somebody might say that smaller companies have slightly higher risk because there's more volatility or there's less that's known. So might be an additional factor there on the price. And then similarly, certain industries might have higher mortality than others, right? So an example of that could be that a company that employs mostly people who work in maybe more dangerous factory conditions is going to have higher mortality than office workers, for example. Although that might not entirely be the case. That is one example of like an industry adjustment or company adjustment that can be layered on. The problem is, however, that that's a very simplistic way of looking at it and doesn't really take advantage of all the data that really is out there. And so really the problem is, how can we use new data sources that exist and that we typically leverage on the individual life side to improve how a company or an insurance company can price group insurance products more or less. And so that's really going to be what guides the case study there. So it's how can we get more accurate on pricing assumptions by using new data and modeling that. So one thing I want to touch on just before talking about the actual project part is the legal and bias constraints. So I've touched on what bias is, I think, a few times here, but if you don't know what bias is, really, it's the idea of disparate impact or unfair treatment to individuals or groups that are being targeted or in the scope of a model or a process. And so a very simple example could be something that is biased against a certain ethnic group because it unfairly charges them a higher price, for example. Now, the whole conversation and the way to think about bias is a little more complex than that. There's explicit metrics that you can use to actually quantify bias in a process and specific guidelines to which bias can fall in and out of to determine whether it's acceptable. I'm not going to talk too much about specifics there, but that's one of the things that I wanted to kind of touch on in terms of consideration before actually starting is bias, because I think bias touches on data science projects sort of from beginning to end. So oftentimes, the source of bias is in data itself, especially if data replicates human decision making. The biases of human beings or processes can be reflected in the data, and then those get picked up by a model or an algorithm and then propagated. And so it's something to always be mindful of. And it's not always explicit, ethnic or gender or anything based bias. It can also be bias of certain populations, right? So I think one thing to think about is there bias in the data? And oftentimes, like, this is even a qualitative question that you can identify off the get-go. So if the sample of data you're using is taken from a specific population, and that population is very different to the population you're going to apply it to, or if it's there's been some sort of censoring on that population that would skew it unfairly towards one group, that could be a potential source of bias. If there is a lot of human decision that goes into the label you're using to train your model, if it's a supervised learning algorithm, for example, that can incorporate bias. So there's really to really consider before going about the process, especially building a model and embarking on a use case. Other ones are ones I've talked about as well. So we have consent to use this data. This is a really a big one. Oftentimes, I think people think, oh, you have data, you can kind of just use it for whatever. But sometimes, having data doesn't mean you can use it for that particular use case. You might have, many companies will have your data and they have it for, administering bills or providing the actual service that you agreed to give them the data for, but they can't just use that data to do whatever they want, right? So you always have to ask yourself, do you have consent to use this data? Talk to lawyers, make sure that you're in the right, and especially if it comes to non-traditional data sources. And then another one is, we have issues with consent using this going forward. And so that can be a complex question as well. On the insurance side of things, I talked about the Colorado laws that came into effect. One of the implications of that is increased scrutiny around certain data sources, namely in the US is the use of credit data. So in the US market, one of the data science tools that's been used within the underwriting process historically is risk scores that are based on prescription data. And some providers of these risk scores started incorporating not just prescription medical data, but also a credit component as well to kind of improve the performance of these models, of these scores. And that came under scrutiny because, tying medical data to mortality risk is one thing. When you tie someone's credit history to their mortality risk, it becomes a trickier subject. Bias comes up. And so because there was increased regulatory burden, I think we've seen a lot of movement potentially away from use of credit within the industry. And so that's also one thing to consider is, are we going to have to revert this or not use this data source going forward? That's always one consideration to have as well. And then are we going to have difficulty even putting it into a contract sometimes? If we would actually use this directly in an underwriting process or any process, are we going to have to update our legal language? Is that going to be an issue? Not all approaches are going to fall under that category. Some are going to be more back office internal, and in that case, you might not have the issue there. The other one is, could the use of this data result in any ethical or PR issues? So an example of that could be, again, using a non-traditional data source. It could be saying, I want to use a facial scan. I come up with like a fake example of this where, the idea is we want to use facial scans to determine if somebody is lying or not, right? You can see that there's, even if you could build some sort of process out, some sort of model that did use face scans to detect some sort of misrepresentation or fraud, I think from the PR perspective, like there's a lot of issues that come from that, right? It's, there's ethical concerns on doing something like that. And I think, that's always something to think about. That's obviously like a very exaggerated mocked up example, but those are the types of things I think to think about as well, particularly if you're creating something that's going to go into the market. Regulatory constraints. So we deal with something called FCRA in the US that pertains to anything that's used to make decisions on people. So one of the things is if you apply for insurance in the US, you have a right under FCRA to ask the company, why was this decision made? So the implications of that are that certain data sources have to be compliant with this. And then if you're using a model, you have to make sure that there's an interpretability aspect of it that can translate whatever result into something that can be explained to a consumer. So that's another consideration as well, is are we going to have difficulty explaining this result to a consumer? Is that going to cause problems sort of under the Fair Credit Reporting Act? And then, increased regulatory user burden, right? So that's kind of going back to the credit thing. Are we seeing movement in the industry, in the regulatory space against doing something like this? And should we think about where the future is before we start doing this now? So really just, before you begin, it's good to think through some of these non-technical questions I find as well. Now, not all use cases are going to touch on all of these. Many, especially internal use cases where there's clear consent to use the data, especially if it's not, external client data. If you're working at a company where all the data is collected in-house, everything's sort of cleared there. You might have to consider a lot of these things, but these are types of things that we would consider before embarking on a project. So the other one I wanted to kind of touch on is, I guess removing the non-technical aspects of consideration. The first step is really understanding the problem, and then from that, understanding the data. So oftentimes problems can seem quite simple, but as you kind of delve into them, there can be a lot of nuance, right? So in this case, for example, we're looking to help pricing within group insurance. And so I haven't introduced this yet, but to do that, we're going to look at medical claims data, and can we use medical claims data on individuals, aggregate those to get sort of group level scores to further segment the risk, right? And so sometimes these things can seem very simple, but there's a lot of nuance there. An example could be you don't actually know what the metric you're going to be is, how much precision you want. how to judge success or failure. Are there going to be any issues with the data set you have? So I think it's important to just think about the problem you're solving, talk to people within the business that have, I guess, more context than you as well, and sit with your stakeholders and actually figure out what you need to do, right? What considerations are that might not be thought about, just in the ideation stage. And I think, once you kind of understand the problem you're looking to solve and you have the data. So in this case, you have, the use case, which is improving the pricing of group life insurance. You have the data, which is, say, medical claims data. And then you have the population you're going to look at, which is maybe, a life insurance company and all of the clients that they have group insurance products with. After you kind of have all these things determined, I think, the next step is really taking that, going into your EDA stage. And in the EDA stage, I think there's a few things to consider. So I think EDA is always a twofold exercise. Here I have it broken into 3 categories, but it's really, multifaceted, right? So there's really the one component of it, which is looking at correctness, right? So with EDA in mind, looking at your data, trying to understand if there are any overarching issues with this data. So for example, in this case, we're going to have medical claims data appended to a population. And when we append that data to a population, now, one aspect of that EDA is going to be looking at match rates, right? And how those match rates might vary by things like age, by gender, to understand if there's any biases there. And we're also going to understand if there's any gaps, right? So are we going to be missing this medical claims data for any particular period of time? Do we see varying quality over any particular period of time? Do we see any data quality issues, right? Are there missing values? And do those missing values follow a pattern, right? Are they sort of randomly distributed in the data, or are they more common on a particular population, a particular period of time? These are all things I think that are useful to do when you're going through your data initially to really understand how things look. And oftentimes in industry and any of these projects, things are not going to be perfect, and there's going to be decisions that have to be made based on some of those results, right? So one example could be that, in this case, you matched the medical claims data and you had a disproportionately higher match rate on older ages, for example. And so you want your match population to look like your baseline population. So what you might have to do is sample over under sample from different aspects of the population you're looking at to match the demographics, the characteristics you're aiming for, right? That could be one example that comes from that as well. Another one is sort of understanding any peculiarities or interesting things about the data, just for understanding how to proceed, how to really process the data and extract features, right? So especially, in our context, a lot of the data we look at is more medical data or health data. And some of it is, intuitive to understand, some of it is not. So I think, understanding what's actually represented there is very useful in understanding how to proceed, and, can really guide next steps there, right? So, as an example, in this case, with medical claims data, you have within it a variety of things. You have things like diagnosis codes, what conditions people were diagnosed with, right? You have various procedures that may have been done. You have places that service they may have visited, for an example, and then different providers of services as well. So, whether a physician administered a service, whether a nurse administered it, et cetera. And so, from this understanding what goes into each of those and sort of what the overlap is can be useful. And then even just understanding like a nuance, like, for example, in diagnosis codes, for example, these come from billing, right? So in this example here, we might have medical data, but it might come not from codes that would be input by a physician for the patient purpose, but for the insurance company purpose. And so that can impute or impart a sort of bias into the nature of the code. Certain things to be overrepresented for billing reasons or underrepresented, et cetera. So those are things to kind of consider, and you might, consider processing, aggregating, doing things like that to adjust the data, right? So those are the types of things I think you can think about when doing EDA. And then really from there, doing more of the EDA that correlates with your project goal, right? So in this example, you're going to try to understand how this medical data is going to be predictive of mortality, right? And so doing things like one-way analysis, right, where you look at particular variables or features and how they correlate with your target, which is maybe a death indicator, are very useful. Understanding how the data is correlated with other features is also good as well, right? So are there features that are heavily correlated? Are there things you can drop? Can you reduce the dimensionality of the data? Things like that, right? As you kind of move away from the sanity checking to the more, say, practical feature engineering stage. Those are sort of some things to think about there. And then oftentimes too, I find one of the most useful exercises when embarking in a modeling exercise, even if you have in mind a more complex modeling structure, say, not like a neural network, but even just a boosted tree. Oftentimes building a simpler baseline model to kind of set a floor for performance is very useful. And it also kind of sets your expectation going into the project. So building things like GLMs, generalized linear models, or generalized additive models, I find is useful as well, even just with a subset of features to kind of understand, is this data going to be predictive? Is there going to be value there? So those are all things to, I think, consider as you're kind of going through that process. So another one here is it's in training and testing the model. So as you're going to move into the feature engineering and building the model stage, I think you should always consider what the choice of algorithm you're using is going to be and how does it fit with the use case. So interpretability is a consideration there, right? You may have very few constraints on interpretability beyond just extracting some top drivers. And so in that case, you're fairly unconstrained in terms of what you use. But if you have more constraints, then that kind of factors into the approaches you can take. So obviously things like GLMs for the most restrictive use cases are going to be more prudent or useful. But even tree-based models, although they may be less interpretable, SHAT values might suffice, but it should always be a consideration sometimes when you're determining the choice of algorithm. And it also influences the way you engineer features, right? So there's certain things like, principal component analysis as well, ways to, aggregate or process features that might be useful, but can also make interpretation a bit more difficult. And so it's always something to think about as you're kind of going through your project is, are people, are end users of what I'm building, what are they looking for? Do they want to be able to have a deeper understanding of what's going on, a more service level understanding at the cost of performance, or is performance the name of the game here? Another one I think that is important here is understanding metrics that are aligned with the goal you're trying to do. So I have here a chart on the right that looks at A to E by size and risk score rank. So this is from the trained model. On the y-axis, we have what's called actual to expected, and we have this on a decile chart. And this is like a very insurance-specific way to analyze performance of a model. What A to E means, it's actual to expected mortality. So within insurance populations, there's known drivers of, or within any population, really, there's known drivers of mortality that we want to account for sort of as our baseline. So as an example, I mentioned, age and gender. We know with age, there's a curve, right? So the older you get, the higher your mortality rate. We know men have generally a higher mortality rate than women. And we know that smokers generally have a higher mortality rate than non-smokers. And so we don't want to just account for those known differences. We want to normalize for those known differences and then look at how much additional performance we get modeling on top of those. And so the way we do that is by looking at this underlying expected and then looking at actuals on top of that to give you a ratio. And so in this case, you have the actual to expected. So the actual number of claims over what you would expect given, age, gender, smoking status, the normalization, and then you have that by the risk rank. And so in this case, they've grouped the score from the model into 5 bins, and you'll see, on the right, the bin there has 50% higher actual to expected. And so it's saying, the model predicts these are the top risks, and they actually do in fact have higher mortality than those in the lower risk bands, right? And so that's like an example of a very use case, industry specific way to quantify the performance of a model. And I think this is a general thing to think about. So in this case, we define this particular metric, but it could be as simple as caring more about false positives than false negatives, right? And sort of adjusting your performance metrics, even your loss functions sometimes to account for that, right? Making sure that whatever metrics you're looking at are going to be meaningful to this use case, because that can influence your ultimate choice of model as well. Also, one thing to note in this use case, although interpretability was valued, did end up going with a tree-based model. So the tree-based model in conjunction with certain things like SHAP values, for example, were sufficient in this case to give the level of explainability we were looking for. And then one of the other considerations in the training aspect as well is the bias testing. So I mentioned bias testing earlier. Oftentimes you can determine a bias metric, right? So there's different metrics you can use depending on what the use case is going to be. So if it's going to be implemented in a process that's going to lead to a punitive sort of outcome, you can have one metric. If it's going to be an assistive outcome, it could be another. But just understanding biases, what variables you want to look at bias by, and having that brought into your training and testing can be quite useful as well. It can uncover some early potential issues that could sort of snag the model, right? So you don't want to go through the whole process of training, tuning a model, only to find out that there's some piece of data that's snuck in that is causing issues, right? An example is in the United States, we have access to some consumer marketing data, and some pieces of that data are more general, right? It could be something like sports participation or likelihood to buy certain products, but others could be demographic information about a neighborhood. And if you accidentally have one of those features in there, it becomes impactful to a model, then that's obviously concerning, right? So you want to be able to catch those things early on. And one of the ways to do that is by kind of validating bias metrics and understanding what's causing them if they are sort of out of band. And then I think too, from this, the process was understanding the problem, getting the data, doing a sort of thorough EDA of the data to understand the specific problems, and dealing with those, and then working with the client to build a model to segment that risk and validating it in a way that made sense to the industry and the context, right? So looking at the relative performance above and beyond what was expected. That expected number, for example, could be at the individual level. It could even be at the company level. But building, training, and validating a model that meets specifications. From there, really the next thing to look at is how to take that model that you built and deploy that. And so deployment can take on a variety of forms depending on your use case. So in some cases, deployment means a very technical path where a model is deployed within an MLOps framework. It's hit by an API within a program in a very automated fashion. Sometimes it can mean deployment in a similar sense where it's containerized, turn into an API, things like that, and access more manually, right? If it's a model that's going to be used by individuals in a more or a less automated sense, you can say. And then sometimes, depending on the technical acumen of the end users, it can mean simpler deployments. So it can mean containerizing it or making sort of a mini application that is used locally on someone's computer. It can mean wrapping that model in a notebook that's sort of plug and play. It could mean if you build a GLM, for example, extracting the coefficients of the GLM into an Excel, right? That's one particular way we've done things in the past. If we have a very non-technical team we provide a very simple model to, you can actually take GLM coefficients, put them into an Excel more or less, and deploy a model within Excel. Now it's not glamorous, it's not very technical, but sometimes it's a way to deploy a solution you've built, right? And so deployment's always a consideration as well when going through these things. And so in this case, the deployment was for a client, and so it was going to be to provide a way to take pools of business they have, run them through the model, and produce these groups of risk scores to allow them to better segment the pricing that they were going to offer, right? So in this case, as well, we also didn't provide, another consideration here is we didn't provide a raw ungroup score. So in this case, they had sort of, this is a business consideration, but a set, say, of pricing groups they wanted to target. Instead of having a very precise number, they wanted some buffers around that. And so instead of giving precise estimates, we allocated groups of people, say, into those price groups, right? There could be another consideration as well, and this could be deployed via an endpoint that somebody can hit with a set of specifications. It could also be something that is deployed internally, and there's a partnership to work with them, right? So I don't remember exactly what the case was here, but it could be a case where we only deploy the model internally instead of making it client facing, and then we work with the client to provide the end results in tandem. These are all considerations to think about, both when building the model and then as you take that model into use. And they can also motivate some of the decisions earlier on. Like I said, if the end user is going to be a very non-technical individual, and you don't want to support scoring a model for them, and you're okay with a more interpretable but very simple model structure, sometimes an approximation or a less technical deployment could be something to consider, right? But these are all factors that you can take into account on a per project basis. Oh, I went back, sorry. So another one I want to talk about is post-deployment considerations. So oftentimes we build models, we go through the process of ideating a problem, understanding the data, building a solution, deploying the solution, and then stop there. I think with data science, all of this is really a continuous process, and so there are MLOps frameworks to deal with that in a more automated fashion, understanding how models are performing, how they're drifting, and sort of automating the update and release aspects. But no matter, I guess, the deployment path taken, I think there's various aspects to think about throughout the whole life of a solution, right? So in this case, for example, we used third-party data to update the pricing process for group insurance products, and so even in a deployment framework that is removed from sort of an automated MLOps, it's important to consider how the performance looks over time. Sorry, one second. Sorry, my son just lowered my chair on me. Sorry about that. So it's important to consider what the performance and the drift looks like over time. So understanding, is the data that's being fed into the model drifting over time, or the outputs of the model drifting over time, and understanding whether or not that necessitates retraining. So that's sort of one more quantitative way to look at it. Another, I guess, way to look at it as well is in a more qualitative sense. So you might train the model on a certain data source, and then another data source becomes available. And so the question could become, we've used, say, medical claims data. Should we now incorporate prescription data? Should we incorporate electronic health record data? Are there additional data sources that, as they come about, can be incorporated into an existing process to refresh and improve upon this analysis or this model, right? And oftentimes you can automate some of that, setting explicit bounds for model drift, or triggering even a manual retraining given the advent of new data. But other times it's more judgment based, right? And so it's one of those things where you have to kind of have a sense of where things are. And then the other one as well is you might have an existing tool that's built for a specific use case, and then an opportunity arises to use it for another use case. So it's important to understand what the implications of that are as well. And then finally, external conditions can drive the need to update and replace existing tools. So one of those is new data. Another could be changes in the industry, right? Adverse regulation can come in and necessitate changes, and so it's important to make sure things are set up in a way that allows you to make those changes and do so in a way that's sort of scalable. So example could be that credit example I gave earlier, where there were risk scores that incorporated credit, and if you're building a solution that maybe incorporates a data source and the regulatory environment changes, ensuring that things are set up in a way where you can go in, make potential changes as needed, and sort of move from there. So in this case, I would say, in the context of this group insurance problem, we haven't needed to make any adjustments yet. It's a relatively newer solution, but it is more of a client partnership type solution. And so, with that in mind, it'll be something that we have to monitor over time to determine the effectiveness. And then if additional clients are, working with it and understand what the impacts are there, and if performance is consistent or if it needs specific adjustments as well. And I think with that, I'll move to the second question period. Let me see what time are we at. We still have 20 minutes, I guess. So I can open the floor for questions now.
We had a question in the chat. Do you use object-oriented programming when you write Python code?
Object-oriented programming. So, like, do you mean within Python, or do you mean do we use other languages like Java or C or?
We had touched upon object-oriented programming in our last class, so maybe that's what the question's referring to. But if you want to chat about, I don't know if you use Java or C++ in your work at all, Tristan, or?
Yeah, so I think I've used a little bit of Java, but I say mostly Python related, and then it really depends on the use case, whether it's more procedural or not, right? I mean, we do write a lot of like methods classes, right, in Python, but it also depends. If it's more, analysis, EDA work, it might not resemble what you think of as more structured, type code like that. It could appear more procedural. That makes sense.
Yes. We have another question that says, from Olga, what visualization tool are you using in your project?
That's a good question. So, I mean, just for, EDA type of work, you use like Matplotlib, Seaborn, visualization tools within Python. We do have a lot of Power BI dashboards, I'd say, within the team as well. So that seems to be a good way to convey visual information, like reports to other teams in those like cases where we do build reporting off of things we do. So Power BI is something that is used, I would say. And then one of the other ways to visualize things is just Excel, right? So, I mean, I think at the senior level, like the higher up you get in terms of conveying the information, the more often you need to bring things into like a PowerPoint or an Excel. Sometimes you can get away with, like, if it's a certain visual that can't really be replicated within Excel, if it's a SHAP plot, like a force plot or something, for example, that you can maybe screenshot or convey to upper management directly. But oftentimes, if it's more traditional chart, bar chart, a line chart or something, kind of have to port it over to Excel just in case they want to kind of poke around, get exact numbers and things like that. But I would say, the big ones in Python would be like, just Matplotlib, Seaborn. I like, yeah.
Perfect. Yeah, on that note too, there is some bonus content included on the GitHub repository, which goes into Matplotlib and Seaborn, which is exactly what Tristan just mentioned. There's another question in the chat, which is, how do you stay informed in this rapidly evolving field, and how do you continuously drive your self-learning process?
Yeah, that's a good question. So, I mean, it's a mix of different things. So, and for me, so one of the things that's not data science, I guess, continuous education that I was doing for a while was the actuarial accreditation. So that to me was more of like the business side, kind of staying up to speed there. Another one I think is going to conferences, right? So that's less about the technical hands-on skills, but more understanding the types of ideas and tools that are being, used either in the industry or in other industries. Conferences are very useful in understanding what other people are doing and where people's heads are at. I think too, just sort of staying up to date online, like things like, I mean, Medium's like a site where there's tons of articles. I mean, you have to kind of use judgment on the quality and things like that, but there's different, sites as well where you can kind of hear about new things. Even just like staying on Stack Overflow and some of those sites and like contributing or being active there, you can kind of get a sense of different problems people are facing. And then I think too, just working with other people in my company and having those conversations kind of keeps me up to date as to what they're doing. And then if I can do little side projects sometimes in areas outside of my normal my like purview, I guess you can kind of get technical exposure that kind of keeps you a little bit relevant. The other thing though, I think that I'm struggling with now, more like managerial or higher responsibilities there, is like staying current technically, right? So I think like, and this is like a problem I think a lot of people have as well, is just like carving out time to focus on more technical work as well, to kind of keep yourself relevant there. I'm gonna say, yeah, conferences, online, chatting with other people are big ones, and then taking from that, like, strategy on like what you should focus on learning, right? If somebody says, oh, I use this new thing, like maybe find a project or play around with that new thing.
We have another question. Actually, maybe Julian, I see your hand up. You can unmute yourself and ask your question first.
Hello.
Hey.
Thank you for this session. It was very insightful and helpful. Thank you, Tristan. So my question is regarding process flow. You mentioned you use historical data in order to run your risk models. So regarding this data, I see you also append third-party data. How that works in the sense of the company does negotiate with those third parties to get this data, because I guess for sure it's not free data. And I would like to know how is the business behind the data. And that's my first question. And the second question is, how big is the impact of historical data, and how you filter the periods of time in this historical data that you have, how you filter the period of time so it's relevant for your model that you are trying to deploy. Thank you.
Yeah, good question. So that's like an entire function of our team, I would say, is finding those data sources and going through the process of getting them. I think there's like a variety of different ways that can happen, but I mean, it's how we kind of find out about it. Sometimes they approach us, right? Because they're companies looking to sell data. Sometimes it's they're companies that have data and they might not even be looking to sell it, but then there's maybe an opportunity to get data from them, and so we approach them. So the negotiations can look different, and then the cost structures can look different as well, right? So some data sources you sort of pay one time, you get an extract of data, and sort of that's it. And oftentimes, if there's a company that widely sells a data source, that's a very painless process. Other times there's, yearly licenses as well. And it's like a per record thing, or, there's different caveats to it. And then there's also, as well in the US, I mentioned like, ways around some of the data privacy aspects where you can still make use of data in like a, private anonymized ways. There's these data exchanges that deal with anonymized data. And so that's one way as well that you can kind of procure data. And I guess the caveat there is that you can't use it for identified uses, but if you want to extract learnings, build models, you can oftentimes use these third parties where they'll take identified data, and then produce a de-identified data set where they've been appended together. And so that's sort of another avenue, I would say. But yeah, the process of actually contracting, getting those things done can be sometimes very painless, sometimes like years long. And in the cases where maybe you're approaching a company that has data they don't necessarily have structured for sale and are looking to sell it, there's an opportunity that can mean like IT projects in their end, which can even extend it further. What was your second question? Sorry.
The second question, it was a long question. So basically the second question is how you filter that data in periods of times. What do you consider a good period of time to be meaningful data for your model?
Yes, very good question. And there's almost no correct answer to that. So this is one of the difficulties we have right now is oftentimes data sources have a defined start, right? It could be, 2005, 2010, 2015. And then you want to have sufficient amounts of data, but then you also want to have a sufficient amount of time to look forward to understand, like if we're modeling mortality, you want a sufficient amount of time looking forward to get the number of deaths you need, right? Because the less time you have, the less deaths you're going to have, the less accurate the model is going to be. But then you also want to take into account that more historical medical data, for example, is going to give you better performance as well. So there's this balancing act where if you move, the date back, you're going to get less history of this new data source, but more look forward, right? And then the converse is true. If you get more history, you're going to have less of a study period looking forward to model mortality on. And so you're going to have just less deaths, less credibility. Things are going to suffer. So there's definitely a balancing there. And it's further complicated right now by COVID because in particular, mortality was very wonky during COVID. Like it was very high for certain groups and it wasn't correlated with different variables in the same way it would be in other periods of time. So that's another thing we have to account for now is how do we account for COVID? Do we exclude those years? Do we model them separately? Do we just include them and add caveats and adjustments? Like there's a lot of considerations there. I would say in general, it's also dependent on the size of population you have. So if we're looking to build a model on every policy we reinsure, we have a bit more liberties to, maybe use 5 years of look back data and then only a couple of years forward. That'll be sufficient to look for mortality. And then it could be two. Some data is less, you want to build a history of an individual, but it's more just attributes. And then in that case, you might only need a single view, right? So it could be like, marketing data that you're trying to use where it has, say income or net worth or something. And like, that's okay to just have, not a longitudinal picture, but just a static picture. And you only need a year of data in that case. But yeah, it's a very good question. I'd say it depends on the project, depends on the size of data, a lot of considerations, but yeah, good question.
Thank you.
Okay, maybe we'll take some of the questions in the chat. We have a question asking, what do you think about Power BI as a visualization tool?
I think it's a good visualization tool for different audiences. I think like with a lot of the dashboarding tools, like they're very, if the alternative is they're sort of manually constructing these reports, I think they're definitely superior. You can say that there's more flexibility in like building like using Dash and Python or something. But then that's a little more technically complex. I think they're generally pretty good for taking data and summarizing it to a variety of audiences, and you can have access controls and everything on them, which is good. I say the one drawback from some of the uses I've seen is like on one of the projects I worked on, the data was quite large, and so it presented some difficulties. I wasn't actually doing the Power BI. I was working with somebody who was more doing the dashboarding, but it presented some difficulties in actually presenting to them. I don't know enough about it to know if it was because we didn't have adequate enough license. Maybe there was, a better version of Power BI that could have dealt with that. But I found that there was some sluggishness as we increased sort of the size of the data. So that's the one drawback that I noticed. But I think like a lot of those dashboarding, whether it be Tableau, Power BI, what's the other one called? Forget the name of the other one that I've used in the past, but they're all definitely very good when you have to sort of deliver numbers to a variety of audiences.
We have another question in the chat. Do you use sophisticated statistics in calculating the insurance premiums? And is there a dedicated team in your company for data management?
Yeah, so first part of that question, I would say, yeah, the actual direct pricing of insurance is handled by a pricing team, and it is not machine learning based, it's more traditional model based, right? They'll look at it. I mean, depending on the product structure, they account for that, but they more or less look at mortality experience, do like a theoretical projection of what mortality is going to be combined with the financials, and then kind of use that to calculate a premium. So I'd say it's like more classically rigorous almost. There's a whole team dedicated to that. In terms of the data management, yes, we do have like a dedicated sort of data management team, and that doesn't just encompass like the underwriting and novel data sources we would use, but that would really look at a lot of the day-to-day data that's needed to run a reinsurance company. So, working with clients when we reinsure business, those clients have to send over, policy records, claim information, financial information, things like that, like constantly, right? There's tens of thousands or millions, but millions of records, tens of thousands of individual files being sent over in a month with, premium and claim information and, change in financial reserves and this and that, right? And so we have a whole team dedicated to like taking that data, processing it, because eventually that, flows up to our financial reporting, to our accounting teams. It gets used by our pricing teams, by our other teams as well, to understand what's going on in the business. So we have a whole like very large team dedicated to that as well.
Carlos, you have your hand up?
Yes, thank you very much. I have a question. And the question is, people who actually got the vaccine during COVID,
okay,
are they actually more risky or less risky for insurance company?
No, I actually don't. My gut would say that particularly for people who are at risk, it probably help mortality. That being said, I don't have a reliable COVID vaccine field in any of the data I've looked at to determine what the relative risk decrease is. So I can't answer that in full accuracy. I will say, just as an overall COVID thing, it does look like post-COVID mortality has more or less returned to normal from my perspective, at least from what I've heard. Again, take that with a grain of salt. This is my opinion alone. But I do think that mortality levels post-COVID have kind of normalized now, which is very good, because I think like there was some concern that as we came into COVID, there might be a lot of excess mortality, but I think things positively are starting to shape up in a good direction overall. But again, like that's still in flux. We're only, arguably a year out maybe. So yeah, interesting question. I don't have an exact answer. Yeah.
Okay, we have a question in the chat from Igor. How often are you using OpenAI API in your projects? And is it possible to use enterprise version of OpenAI in your company, or do you have a restriction for that?
Yeah, so I would say this is always so fun. So I don't actually work on most of the LLM stuff now. Early in my career, I did a lot of NLP, and for some reason I like overdid it, and I didn't want to do any NLP anymore. So I don't actually do much of it. In terms of using it personally, I also only used ChatGPT for the first time a couple weeks ago, funny enough. I was like, let me try this out. I'm very like I don't know what the word is, like not backwards, but like old fashioned when it comes to certain things. I didn't really use it for summarization or anything, or like even I still use Stack Overflow versus asking ChatGPT. We are using it within the team for I guess different uses. But we do have very strict corporate guidelines on the use of the publicly available versions of these LLMs. So because there's concerns about where the data is going, security, blah, 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 we have information security levels, and only very low security levels of information is allowed to be passed to the public versions. And then we do use internal versions of these for any more serious use cases, and they're hosted separately with different constraints around the data. So yeah, you can use them. You can use the publicly available LLMs for non-sensitive data, and then anything that's sensitive or really business focused, I would say we're restricted to internal versions of those models. Yeah.
Maybe we'll take one last question if that's okay.
Yeah.
So Coco had asked, we have two modules to choose in the future. We have the data science module and also the machine learning module. So with the data certificates program, the participants can choose one of those two paths to go down. And then the question is, what is your perspective on the course for career path and your suggestion?
Good question. So the machine learning is more software focused, right, Kelly? Am I remembering that correctly? Like
Yeah,
the course of, yeah.
Mhm.
I mean, I think it depends on what you enjoy doing, right? So like I think within the field, like there's jobs in both. They're more, you'd say, model or analysis based versus more, deployment engineering focused, right? And I think like what you gravitate towards there is going to influence that, right? Like I would say I gravitate towards the former, right? Like I enjoy more of the analysis business aspect and less the more intensive like software deployment, infrastructure type of work related to data science. So I would gravitate towards the data science side of things. But I know a lot of people do similar things that I do that really enjoy more of the engineering work. And so I think if you have a preference towards that, and maybe eventually want to move into even purely like engineering role or more like DevOps, MLOps kind of role, I think like the latter, right? But it comes down to like personal preference, goals in that respect. Yeah.
Yeah. I think we'll end it there. But thank you so much, Tristan. That was
Thank you.
a really great session. If folks want, we can do a virtual round of applause. But yeah, thank you so much, Tristan.
Thank you.
And then for everyone else who's interested in sticking around, the learning support will have half an hour of office hours.